Let's welcome on board Daljeet Singh Kohli as well and find out what he's recommending in this market before we talk about all the stocks in news this afternoon. Daljeet, hi. What does one do in this market? Time to protect capital or do nothing right now?
Good afternoon. No, I think it is giving you good opportunities for loading up on the stocks that you always wanted to buy at a cheaper price. It is coming out for last 2-3 months. We've been hearing everybody talking about market गिरता ही नहीं है, small cap, mid cap नीचे ही नहीं आ रहे. तो अब now when it is coming, this is the time when you have to show your conviction. Now, obviously, market has its own way of removing the froth out. There were defense companies, railway companies, lot of stocks which were trading at abnormally high valuations. So those valuations are now coming to the right place, and that correction will happen. That will always happen. So I think in this bargain, if you get your good stocks and if you have to be little preemptive on what sectors can take over from here onwards, then this is a good opportunity for people like us. We are actually using this as an opportunity to add on some of those themes which we always wanted and which are now giving us a better opportunity to add.
Those themes and which are those stocks? I'm sure that's what is on Aisha's mind as well.
So stocks, I would not be able to call out because of the compliance reasons, but I can give you the themes and the hint about the sectors. So for example, we are looking at agrochemical is one theme, which is where we feel that the bottom is probably in sight now, maybe 1 or 2 more quarters where we'll see some pain. This quarter, most of the companies are going to show very bad numbers. One of them has already come out with the numbers, which was not so great, but then it is in the price. So this is if one is of the view that over next 1.5 years, this cycle will bottom out. So you will get a lot of opportunities in this segment. Second is in autos and auto ancillaries. Again, we are very positive. The data which is coming out every day in terms of festive sales and all these supply issues going away. So auto sector is doing very well. So the suppliers to all these companies, maybe a forging company, maybe a lighting company, maybe some seats and all those ancillary companies across the board. There are quite a few of them which can be of good interest and which are now available in last 2 days only 10% cheaper. So that is giving you a good entry point there. So like that, we are looking at those sectors. Metals, we remain quite bullish. We have added some now in metals again. Instead of going to the top metal producer or the straight away going to the big names, we would like to go to the integrated players, not integrated in the sense of mines having, but integrated in sense of having a wide range of products, which are actually a consumer product. No, so which can be used like pipes or other things. The producers of steel, which will go into all these kind of construction activities. So that again is giving us a good opportunity. So that like that, there are few themes which are working. And then consumption, we have not had any stock of consumption in last 1.5 years. I think now the time is coming. Again, post these results, we've seen some companies showing only 2-3% of volume growth. And now this is not going to remain always. And in an inflationary environment, we expect that inflationary environment will persist. So in an inflationary environment, FMCG companies, consumption companies normally are beneficiaries because their nominal value goes up. So they can be actually beneficiary. And if they are available again, because of this correction, they are available at a better valuation, we would definitely want to load up.
Right, okay. Let me also welcome on board then Jai Bala and find out what he's making of the market right now. Jai, what's the sanctity of breaching this 19,200 mark?
Hi, thanks for having me on the show. See, 9200 is not a significant support level, but the market is probably bracing itself for a much bigger decline. And at the moment, there are significant breakdown in the Nifty banking index and the market leader, the FMCG stocks and the capital goods stocks. So basically, this looks like the start of a much bigger decline, and this is just only a preamble.
Much bigger decline for us? Are we talking about a 500-point correction? Could it be much worse?
So the minimum the market is, in my opinion, is going to drop to about 18,500. And so when the market gets to about 18,500 to 18,400, I will evaluate the market at that point. That'll be a decision point for me. This does look like the markets are going to drop below the 2022 low, but that's at the moment I'll keep that as a evaluatory. I will take that a firm call once the markets break below 18,500, 18,400. If you look at the global macros, it does look like the US markets are shaped to decline really sharply. The rally the US markets had between May and September, May and August, it's come to an end. This has been my view since September, and so given that environment, and I'm expecting the US dollar to strengthen and the US rates to go much higher. So I expect global macros to come and play and have a significant impact on India.
And considering it is all correlated with how the US yield has panned out, Jai Bala, if you've been reading those charts, does it seem like it's going to continue at an elevated mark of 5%?
Yeah, see, when the US yields were trading at about 113 pips in July 2021, I had put out a medium to long-term call for 325 to 400 pips. That seemed outlandish at that point of time. And now we are at, we have touched a print of, 500 bips for the US 10-year. But my long-term call for the US 10-year is about 800 bips. But at the moment, in the short term, we could see some cooling off, and that will be due to a flight to safety. The bond markets are meant to, usually meant to provide a safe haven when the equity market starts to tank. So that's exactly what is likely to happen. And I see the yields cooling off because there will be a flight to safety to bonds.
Flight to safety when it comes to bonds will happen. But just before we slip into a short break, Jai, your view on the mid-cap and the small-cap space as well as Bank Nifty. So you talked about how at the Nifty index level, you're talking about 18,500. Are we expecting a bigger cut when it comes to the mid-cap and small-cap purely because they had run up quite sharply, 25-30%?
No, if you look at the mid cap and equity, small caps, they have nearly doubled from the March. They didn't double exactly, but they were slightly short of the doubling level. So that's a steep rally in a short span of 6 months. And whatever profits people are having right now in the mid cap and small caps, they need to pocket it because that will evaporate really soon. If the 18,500, 18,400 on the broader markets come through. And, the other part is that, you spoke about banking index. We spoke about the banking index having a significant long-term resistance. We had mentioned the last interaction. If you draw a trend line from the 2008 high, 2013 high, 2016 high, that comes at about 47,000 for the banking index. And now, yesterday's close for the banking index has completed a double top. That's a very significant move for the banking index. And this is occurring at the back of a head and shoulder top for the Nifty index. So the indices which have been very strong, like the BSC, the bull market had been led by Nifty Auto, Capital Goods Index, and the FMCG index and the realty index. All these prime indices are showing a reversal in trend, but we need to see if the medium to long term supports hold. That's what we are trying to evaluate when the markets get to about 18,500, 18,400. So at the moment, 18,500 is a given for me.
Okay, we're going to take a very quick break. When we come back, we'll of course continue our discussion with all of our experts on board. Back with closing trades, and it's definitely not a pretty picture after a day's break at a time when the globe is actually holding up okay. We've breached some significant marks like 19,200 on the index. In fact, well sub 19,150 as well. It's a cut of a good 135 points that you're seeing. Pretty much across sectors, the weakness persists, barring, of course, few odd like metals, technology, FMCG, which are relative outperformers. But the weakness in telecom, media, power, financials, pharma, infrastructure, cement, autos, that's pretty prominent. Even the breadth of the market has, been challenged today. It's a 2:1 ratio that we're clocking currently. But Kunal, just wanted to get your sense at a time when we've seen fair amount of resilience, and it's almost on a year-to-date basis, the previous year as well. The small and mid caps have done way better than the large caps. Do you see that continuing?
No, I think I see a definite tilt from the small caps and mid caps towards large cap names. Every market correction or a new trend comes out with a new sectoral balance. Like for example, in the last leg of the market uptrend, there were a lot many mid caps and small caps which are doing pretty well. The large caps underperformed. I believe now could be a sign where the mid caps and small caps would start to underperform significantly, and the tilt towards the large caps would be a lot more positive. So by that I mean, looking out for the underperformers, for example, the likes of HDFC Bank, Kotak Bank, Reliance Industries to a larger extent, the FMCG majors, many of these stocks could actually turn out to be good buys, at current levels. Because my sense is that whenever this churn happens, this may not just be a 1 or 2 weeks of churn which you're looking out for. This ideally turns out to be a 3 to 6 month kind of a sector trend. So I believe in that regards, tilting the mix of the portfolios could actually be a better strategy rather than just sticking to the portfolios and hedging the mid cap end of the portfolio.
Okay, so that's a take coming in on the portfolio. But if I can come back to you, Jay, within these sector allocations, which is the space which is looking the healthiest, or perhaps the place where you would want to hide right now?
Yeah, if there is any sector, that would be the pharma sector. I think the pharma has one pending high to come through. It's an incomplete structure for me. So I would treat only the pharma index as a buying opportunity, and I'll be a little more, nuanced and more patient there. Other than that, I don't see any other hiding place there. It's better to go to cash.
Better to go in cash. That's the big call coming in. Nooresh, let me quickly get you also in the conversation, and I want to specifically talk about the charts of ICICI Bank. A definite weakness today, almost a 2% slide, and even Axis Bank ahead of its earnings is not looking too powerful right now.
So the whole banking pack has been a little odd in terms of price action. So expectations was the trends could get sharper. We saw breakout of 960, faltered at 1000 ICICI Bank, and now we've gone below that 960 mark, and now we are testing the lows of June, which was around 910 odd levels. 910 to 900 is a support which is very important. If it starts breaking below those levels, then we get into a much deeper correction. So out here in the banking index as such, given that it is the most highly owned, as well as from the FII side as well as on the mutual fund side, price action as of now is weak, so not trying to find a bottom here. We've seen a breakdown below 43,500 on the bank Nifty as well. So till the time we don't go back above those levels, I would rather let it be in a slow and steady drift. So no view at this point of time, no real trade. Result reactions could be not followed up. So we saw a price action of positive on IndusInd Bank post numbers, and now we are back to the same prices which was their pre-results. So for now, banks are under pressure. They are more sideways. The largest one is sideways. ICICI Bank is struggling to make a move beyond that 960 mark. Same way, Axis could not sustain that 1000 mark and tried to do so for weeks together. So for now, it's a sideways drift on the whole banking space. We'll start looking at it once we start crossing 3-day highs on any of them. Till that point of time, let the drift continue.
Daljeet, if I could get you in as well, wanted to understand what's looking like the weakest link in the market right now, sectorally to you. Does it continue to be IT, or you think it could be banks as well? Daljeet?
Is it for me?
Yes.
Okay. So see, in fact, we are not looking at IT as a weak link, and we feel that probably all this news is very well factored in the stock prices. Yes, they can slide a little more because of the market reactions, but then these companies which we are looking at, they are doing some specific work which is required for these for their clients to run their day-to-day business. So it's not going to be out of the business. Yes, there are delays. If you see the results of all these IT companies, deal wins have been very strong. So and now they can convert into revenue over a period of time. Earlier, we used to see the deal win has come and immediate conversion starts, but now probably there would be some delay. And that delay would not be 1 or 2, maybe 1 or 2 quarters, not more than that. So I think it is actually the time to look at IT with the perspective of 2 to 3 years for building your portfolio and adding at every dip probably. We have one or two companies which are frontliners in the IT pack, one from the large cap and one from the mid to large cap, you can say. But we will obviously be adding some of these more over a period of time as more visibility comes. And we are basically banking on the deal wins and the client concentration that these guys have.
Okay, point taken. So, good time to start building the IT portfolio from a 2 to 3 year horizon, but it's not completely down and out. There are stocks and outliers which are holding up okay. Pull up a Welspun India. That stock has surged 12% after it reported its earnings. So, a very solid set coming in, and that's coming after months and quarters of underperformance because the export market was hit. But this time around, we are seeing a definite reversal. The other export oriented stock which is doing okay is PDS. That's, of course, into apparel retailing, etc. So that is also higher by 7%. Separately, BSE continues to build on gains. So that stock is higher by 5%. You also have select real estate names, the likes of Anantraj, etc., which is higher by around 3 to 4%. So watching out for some of these names. In fact, Daljeet, do you watch this space closely? Textiles, especially export textiles, the likes of Welspun, Gokuldas, KPR Mills, etc.?
Yes, we do. We, in fact, one of the names that you have taken, we are also interested in that and working on that, though it is right now not a part of our portfolio. That's a disclosure. But we are looking at that because you see, after 1.5 years of inventory rationalization at their customers' end, most of these companies are now seeing that reversal coming in. And on the other hand, the crop on cotton, which is the basic mainstay for most of our exports, that has also been in line with expectation. So which means till last 1.5 years, we have seen that Indian cotton used to be at a premium of export prices, more than 20-30%. At one point of time, the spread was more than 20-30%, which meant that it was not feasible for any buyer to buy things from India. Now all that rationalization has happened, and most of these companies are on the track to go back. So maybe the home textile companies, there are 2-3 of them which are definitely poised for a good growth. Things like Gokuldas, they are already moved so much and people have already built in a lot of expectations from them. So maybe their valuation comfort is not there, but other companies which have not yet moved, or the companies which have just shown good results and people are extrapolating that, I think that's the way to go. In fact, the overall view is also this, that stocks or the sectors which have not performed in last 6 months, and if there is a strong fundamental reason or there is a change happening there, those are the things which one has to look at for their portfolio. You see, for last 6 months, most of these companies have doubled, almost 60-80% from March to now. So obviously the positives have already been factored in. Now from further to go from here, what is there to re-rate? Nothing. So it's better to look for those companies where the changes are happening in the sector or the stock specific, where there is some change happening, and that change will actually drive the stock re-rating. And that is where we are actually focusing on.
Okay, Daljeet, we'll let you go on that note. Jai, if I could just come to you and, get in a last comment. I mean, I know you're bearish on the market right now and you definitely see way lower levels. But any contra calls that you spot right now?
Contra calls, are you looking at buy calls? No, I wouldn't suggest that. If you mean by contra, by buy calls, no, I don't have it. Even for the pharma sector where I'm bullish on, I'm waiting for another 300-400 points drop on the index to come through. Only then I will get bullish on it, and I would like to see a reversal there. I will not pull the trigger right away. So I'm just in a wait and watch mode for buying, but there are umpteen shorting opportunities, and the banking index hasn't had a red October for the last 10 years. The fact that it's likely to do it for the first time in October since 2012, that itself is a significant factor for the overall market. So be cautious. Holding cash is one of the toughest things to do, and for those who can manage to do that, they'll be having a win year after year. Half yearly after every half year. So having patience, holding cash is the most important thing.
In capital preservation, that's the motto right now. But on that note, Jay, we let you go. Thanks so much for joining us. But let's take the closing trade ideas as well from Kunal and Nooresh. Nooresh, what's the closing trade idea, if any, or you're sitting in that no trade zone?
So mainly in a no trade zone, but a small trade would be to go short on PFC. The stock has been the best performer in the whole power segment. So a very strict stop loss at 242 and expect some bit of a correction to 230, 232 levels.
Okay, at least there's some buying opportunity which is still emerging. Kunal, what about you?
So yeah, Polycab is something which I'll look to go for a closing trade on the long side. Looks attractive in terms of the risk reward at current levels of 5,030 where the stock is trading.
Okay, time now to slip into a very short break, but don't go anywhere. Market is very precariously placed. We'll keep tracking last 30 minutes of the trading session when we come back.